All right, welcome everyone. So please note that this session will be recorded for informational, educational, and marketing purposes. Our event will begin shortly. Good evening from Singapore and good morning or afternoon if you are joining from other sides of the world. On behalf of Nanyang Business School NBS, United Nations Supported Principles for Responsible Investment (PRI), and European Corporate Governance Institute (ECGI), a very warm welcome to our eighth and also the final lecture of the NBS-PRI-ECGI Public Lecture Series on Sustainable Business for this year. My name is Yuxia Zou. I'm assistant professor here at NBS, and I'll be your host for this session, representing our lecture organizing committee. So our NBS-PRI-ECGI Public Lecture Series is a global initiative starting this year from January, aiming to facilitate knowledge exchanges among academics, practitioners, and policymakers in the field of sustainable business. Each lecture features a 60-minute talk by a leading scholar and a 30-minute Q&A moderated by an industry expert to help connect academic insights with practical experience. After each lecture, the event recordings and summaries will be shared online on YouTube to build a public library on sustainable business for all. So if you missed any of our earlier talks from January to October, please check out our recordings on YouTube and summaries via the ECGI blogs, as you can see some recent snapshots on the slide. So today we're going to look at sustainable investing, focusing on the link between goals, actions, and outcomes. So it's my pleasure to introduce our speaker, Professor Ayako Yasuda, Maurice and Marcia Glaher, Professor of Finance at University of California, Davis, Graduate School of Management. Professor Ayako is a leading scholar in financial economics with a focus on venture capital, private equity, and sustainable finance. So her work has been published in prestigious journals such as the Journal of Finance, Journal of Financial Economics, and the Review of Financial Studies. Her work is often featured in news such as the Wall Street Journal and the Financial Times. She has also co-authored a textbook on venture capital and the finance of innovation published by Wiley recently. Her research has won many awards, among which is the 2016 Moskowitz Prize on her impact investing paper published in Journal of Financial Economics, or JFE. Besides her academic research and also teaching activities, she also has a lot of contribution in the real world. So Professor Ayako shares a special connection with PRI as she has been contributing to the PRI in-person conferences as a member of the Academic Network Conference Committee. And she was also at the very latest PRI in-person conference in Brazil. So I guess many of you have seen her there. And I believe her face and name is familiar to not only the academics, but also the practitioners in this virtual room. So today, Professor Ayako will share her insights on value, moral, and impact, sustainable investing goals, actions, and outcomes. After the lecture, which is about 60 minutes, we'll have a 30-minute Q&A. And some of you have already submitted questions upon registration, which are greatly appreciated. During the lecture, if you have any questions, please submit them via our Zoom Q&A function, and our moderator will try to address as many questions as possible. Okay, now Ayako, please. The virtual floor is yours.
Thank you. Thank you, Yuxia, for the very kind introduction. And thank you, organizers, for having me. I'm really honored and excited to be here today speaking to this very global audience about the very wide range of goals that fall under the umbrella of sustainable investing, what those differences mean, particularly for impact investing. I'm also thrilled to have Asha Mehta as our moderator. And I'm really looking forward to our conversation and to hearing your thoughts and everybody's questions later in the session. Let me share my screen. Okay, so here we go. Today, I'm going to be talking about the goals, in particular, what is sustainability in sustainable finance? Is it the sustainability of the planet, sustainability of the portfolio value? Also, when an investor wants to be socially responsible, does she believe she's being socially responsible based on what principles she followed when making investment decisions or what outcomes her decisions generated? I'm going to be making this distinction between the two. And what really we care about at the end of the day is what goals motivate households to invest in sustainable funds. And that's on one hand. And then what kind of goals do sustainable fund managers pursue while they're competing for capital flows? So these are the type of questions that I will be touching on in my lecture. To set the stage, I'm going to introduce three archetypes representing each of the three goals that I'll be talking about. These correspond to the three sustainable investing goals. Sam says, I feel uneasy knowing that my retirement fund might invest in private prison companies. Even if the returns are good, I just don't want to profit from something that I find morally troubling. Inger says, I care deeply about access to clean water. I put my money into companies that are actually working to make that happen. And Ellen says, I see the world shifting toward renewable energy. I want to protect my portfolio from stranded asset risk, climate risk, and make sure that I'm not left holding yesterday's investments. So these three characters correspond to the moral values driven sustainable investing, real world impact driven sustainable investing, and financial materiality driven sustainable investing. They're distinct goals. The question that I think is pertinent is, can sustainable funds serve Sam, Inger, and Ellen all at once? When we have these three goals under the same umbrella, I think there is a possibility that there are some tensions in portfolio choices. For example, for impact, holding some brown firms and inducing them to become green will benefit public, and that entails some private costs and risks, but it would be a worthy goal for impact choice. It would be consistent with their goal. Whereas for financially driven funds, their goal is to enhance financial value through ESG integration. Its goal is private benefit as opposed to public good. So seeking to avoid rather than bearing risks associated with environmental and social challenges, that would be very consistent with their financial goal. And separately, moral funds might prefer holding only already green firms. That would be consistent with the utility function of their underlying moral investors. All we are saying here is sometimes those three goals might not converge. So that is a challenge the sustainable investing face. I'm going to be defining impact investing as having two criteria. One is that it is explicitly dual objective. And impact investing has two goals. One is to generate both positive and social or environmental impact, and as well as a financial return. So both are explicit goals in and of themselves. Impact investing is also inherently activist because it needs to play an active role in inducing the positive change outcomes the companies that they invest in after the investment decision has been made. What is an impact? I think in academic research, we think of it as externality or public good. Externality can be positive or negative. So we either want to increase positive externality or reduce negative externality. But either way, externality is a benefit or a cost that is created or imposed on society that isn't fully captured by market prices. So since it's not fully captured by market prices, if it's a benefit, it's not fully absorbed into the private benefit. It is enjoyable by everybody. So we can think about clean air as a very good example on the good side, and pollution, health impacts, resource, biodiversity depletion, etc., as on the negative side. So impact funds aim to create this public good that is available to broader society. I think that's a very good distinction. Here is some more concrete example of an impact fund. South Asia Clean Energy Fund. It's a impact VC fund, needs to raise capital. So from investors or limited partners, for example, IFC being one of them. And then once the fund is raised, they would find some private companies to invest in. So portfolio company examples include Prince Pipes, ESDS. These companies provide a financial return. This is a for-profit company. And if the fund is profitable, IFC receives a financial return. It also generates some environmental impact, either through, in this case, rainwater harvesting or conserving water or conserving energy. This is the additional externality or the environmental return. So this meets the criteria of an impact fund. And the return externality could be environmental or it could be social. To categorize these three goals, we can also think about two dimensions, objectives and beliefs of investors. On the objective side, financially driven sustainable investing, the objective is still singular. It is the risk return characteristics of the vehicle. So that corresponds to Ellen's goal. And what we say in ESG investing, these are not exact one-to-one match, but broadly fall under this side of the spectrum. Whereas both Inger and Sam's objectives include some non-pecuniary preferences, or utility function has some non-financial objective. To differentiate between the impact and moral, we can think about the difference as the beliefs about social responsibility. Inger type of investing is output-based because it's about whether you change the world for the better. It is a consequentialist type or output-based belief about social responsibility. Sam's belief about social responsibility is more input-based, whether he thinks something is inherently good or bad, and he does not want to include something that's inherently bad in the portfolio. It is input-based and it is deontological. And of the three, only impact investing is explicitly designed to induce change by generation of externalities by corporations. So when we talk about greenwashing or impact washing, that is if you aim to generate something and then you fail to generate it, that is consistent with that. But if you're never aiming to generate something, then I think it is not really greenwashing or impact washing, but rather it is not the goal of investing itself. Just to expand on that output versus input distinction a little bit further, these two types of social responsibility comes from a philosophy in ethics branch of the philosophy. How do you aim to be good? There are two branches of thought. One is consequentialism. Consequentialism says what is best or right is whatever makes the world best in the future. This is exactly aligned with impact investing, where outcome measures, for example, reduction in emissions, those are used to gauge its impact and its success, along with financial return. Whereas the other school, deontological, or sometimes associated with Kant, it says the morality of an action is based on whether that action itself is inherently good or bad, or right or wrong, under a series of rules and principles. So it is not based on the consequences of the action. The outcome does not justify the action. The action itself is pre-categorized. So this moral responsibility is aligned with negative screening of certain sectors, tobacco, alcohol, and now fossil fuel energy for some funds, irrespective of consequences. So deontological investors, if that is her belief, is not basing their actions on whether their exclusion decisions actually induce the excluded companies to improve their ways. Now, economists and policy makers can still be interested in whether that happens or not, but I think that distinction is important to make here, in a sense that even if the companies do not change, that might be satisfactory to deontological investors because it is about whether the portfolio remains green, portfolio remains virtuous. And I think that actually might be a very popular sentiment, as some studies suggest. So that has implications for sustainable investing. So, as I alluded to, there is a dilemma between two investor motivations. Both are equally valid, and both may be equally important to some investors, sometimes to the same investors doing well by using ESG information to pick stocks or asset classes versus doing good to benefit broader society and environment. And if they coincide, great. If they are positively correlated, traditional investors will provide capital. So we don't really need a separate category of investors. But they don't always coincide because they are not inherently same goals. So when they diverge, that's when a dilemma becomes important, and fund managers will need to choose which to prioritize. So then it becomes an important questions to know which goals are being prioritized. I'm gonna get to that. There are some literature on the theory side about both impact investors and moral investors. And the literature is broad and there are a lot of papers, but in the interest of time, I'm just going to pick a couple of papers that illustrates the essence of impact investors very well, in my view. Impact equals externality equals public good. Public good, as we learn in economics, is usually provided by governments or nonprofit organizations by nature. And the question is, when can this be provided by, or should this be provided by for-profit firms? According to Milton Friedman, that is never. He famously argued that firms should always purely maximize profits and distribute the profits to the shareholders. And shareholders then, in turn, can decide private decisions. And if they are civically minded, then they can donate some of the profits to charity, which then generate the public goods. So this separation may have some efficiency benefits. So when should for-profit firms provide public goods? When is there a overall higher efficiency or optimality for society as a whole? That is a good question to consider. So starting with Friedman's condition, where the firms provide profits back to the investors. Let's suppose investors are impact investors. So they care about externality. They care about both positive and negative externality of firm activities. And therefore, they want to donate to charity, which then provide some public good using the donation. There may be two problems with this mechanism. One is there is a free riding problem in private decisions to donate to charity, because once the public good is produced by the charity, it is enjoyed by everyone. So even though impact investors care about that outcome, there is a free riding incentive. So instead of donating lots of dollars, they might be donating cents instead. So it might end up in equilibrium under provision of donation. The second problem is that firms generate negative externality that might be ineffective or impossible to undo through charity. And it might be much more efficient or effective if the firms reduce the emissions in the first place. So under these two conditions, the theory tells us that impact firms might emerge as solution that is optimal. So moving from the original mechanism, we can have impact investors ask impact firms to cut back on emissions. This entails some cost, so there will be reduction in profits that impact investors receive, but there is increase in public goods through reduced emissions. So in this new equilibrium by Morgan and Tomlinson paper, impact investors are financially poorer, but they are happier. And ultimately, they care about the total utility function, not just the financial portion of the utility function. So this provides a rationale for firms to be socially responsible. And it's a centralized decision by the firm where impact investors are able to coordinate better and solve that free riding problem that it had in the previous mechanism. So how to solve the free riding problem when the outcome is a public good, I think it's always a very challenging problem to solve. And it turns out that impact investing continues to face this challenge. And I think this shows up in some of the results that we show. For example, that it does not scale as well as other types of sustainable investing. So in the theory paper, if everybody is an impact investor in the economy, this is a great solution. We know that in practice, investors are not homogeneous. So even sustainable investors, their heterogeneity in what among them, and then there are non-sustainable investors who only care about financial outcomes. So we can think of it as a good reference point, but the reality is more complicated. Having established how impact investors would behave, do we find that investors that we can think of as impact act this way in practice? So this is where empirical studies come in. One of my papers study investors' decisions to invest in impact VC funds. These are set up like VC funds. They are for profit, but they do have explicit dual objective. and VC funds are all activists. And investors in VC funds are mostly institutional investors. They are pensions, foundations, some development banks, endowments, university endowments, banks and insurance, sovereign wealth funds, etc. And we get to see the type of investors each fund receives capital from. And the question that we wanted to address in this paper was, do investors investing in impact VC funds exhibit willingness to pay for impact? So are they willing to trade off some expected return from the funds, financial return, in exchange for impact? We are going to focus on the decisions to invest in the funds. Unfortunately, in VC and in other investment classes, it is not possible for researchers to have a comprehensive outcome measures of impact at this stage. I wish we can, but that's not possible. So here we are looking at the ex-ante investment decisions. In a later study I will talk about later in the lecture, we will look at some impact outcomes, particularly emissions. So in this paper, we measure the willingness to pay by investors in terms that can be converted into a ex-ante IRR. And depending on how the models are specified, we get a range of estimate between about 2 to 3%. So what that means is that on average, overall, investors are indifferent between investing in impact funds with lower expected financial return in the order of about 2 to 3%, and investing in traditional VC funds that generate no impact. So that gap is their willingness to pay. But this overall results masks a great deal of heterogeneity across investors. So we look at that heterogeneity across multiple dimensions. And I'm going to show you some of that results. We look at investor geography, the domicile of the investors. We had our prior was that given other circumstantial evidence, European investors may have a greater demand for externality, and they will be therefore willing to trade off more of that externality. And indeed, that's what we find. The investors from developed Europe, emerging Europe, as well as Africa and Latin America, they exhibit a higher and larger willingness to pay. In contrast, investors from North America, they still have a positive and significant willingness to pay, but the magnitude is more attenuated. We don't find significant willingness to pay from Asian investors, but I note a caution here in over-interpreting that results, because the sample in our sample period for investors from Asia was fairly small. So we cannot differentiate between lack of willingness versus lack of power. It would be great to see a larger sample to see if that has also changed over time, as we know that the amount of capital has grown significantly. More interestingly, we wanted to see the type of organizations and if what kind of organizational types the investors have, and if that matters in terms of their willingness to pay. So just looking at the designations, we had about 10 organization types, and we do find that development organizations, banks and insurance, and public pensions all have positive willingness to pay, but others, for example, endowments, do not have positive willingness to pay. So you see there is quite a bit of heterogeneity from positive to 0. We wanted to delve this unpack these results a bit further, and in order to do that, we then coded each investor by attributes. There are 6 dimensions of attributes. So these are things such as whether it's a mission-based organization. So foundations and development organizations, they have a non-financial mission. And we thought that, hypothesized that that would be associated with a higher willingness to pay. And we do indeed find that's true. We also can observe whether or not each organization is a UNPRI signatory. And given that this is a cost that they pay to be compliant, they might have a greater willingness to pay. And we find that, yes, organizations with the UNPRI signatory status have a higher willingness to pay, and especially post signing it. So not only this is a fixed attribute of the organization, but also after they sign, their willingness to pay increase over time. We also find this interesting result that politics and regulations matter. So certain organizations are known to be under political pressure to invest in impact. So public pensions are good examples. They are often pressured by either a political establishment of their jurisdiction or people on the board from political side to provide, especially for increased welfare for the local population. So create good jobs, things like that. Not so much invest in a region far away from them, but this is very much a locally based impact investing. And we find strong results that the political pressure for public pensions, as well as banks and insurance companies in the US, are subject to what's known as a Community Reinvestment Act in case of banks, and similar state-based regulation in case of insurance companies to explicitly invest in local low and middle income communities. And this seems to be binding. That's the positive externality, a positive willingness to pay. We also find certain restrictions by law has a negative impact on their willingness to pay. And this plays out in the US. So perhaps partially explain the smaller willingness to pay by US investors. So certain organizations in US are subject to a particularly strict fiduciary duty requirements to consider non-financial characteristics only when they can essentially establish that it will have no impact on the financial return. Other same type of institutions in other jurisdictions are not subject to such restrictions. So this includes private pensions, foundations, and endowments, and public pensions in the US as well. So overall, these group of investors, the fiduciary investors, exhibit negative, has a negative impact on the willingness to pay. And finally, when we look at the impact category of the type of impact that impact funds pursue, we find larger willingness to pay in case of funds that are pursuing goals that are considered more higher public good or externality content, so more severe market failures, so environment, poverty, minority and women, and much smaller and insignificant willingness to pay for things such as small and medium enterprise funding, where there may be purely financial capital may be more available for such goals. So that's consistent also with the non-pecuniary utility, making those investors more willing to trade off when there is a greater need for externality to be generated. So to summarize, we find that investors accept lower expected IRR or willingness to pay for impact funds compared to traditional VC funds. I think that establishing this was important to alleviate the concern that nobody is in fact have a willingness to pay. We do find that they do have willingness to pay, but we also find that there is heterogeneity. So not everybody is willing to pay, and some are, some aren't. And certain type of organizations, certain geography, Europe, and UNPRI signatories, they have high willingness to pay. I think it's important to know investors with mission objectives or those facing political pressure do have willingness to pay. US style fiduciary duty have a negative effect on the investor's willingness to pay. So that may mean that that's constraining some impact investors' welfare maximization. That's a possibility. And that means that policy has a role to play in changing the outcome of capital allocation. So I think that is a hopeful finding because that means policy matters and we can affect the outcomes. Moving on to the second type of investors, the moral investors. How do investors so this is Sam, so investors who exclude sin or brown stocks from their portfolios, how are they different from impact investors who are tilting towards public good production? Again, I'll feature a representative paper, but there are other papers that also study this type of investors. So this is just a small representation of the literature. If investors only feel morally bad about their own portfolio carbon footprint, then they invest only in already green firms. This solves their moral problem because their moral problem is associated with their own portfolio. Does this solve the global problem of too much emissions? That depends on who else provides capital to these steel brown firms. Impact investors, on the other hand, care about how much positive externality their actions generate. So they're comparing a hypothetical reality in which they don't invest in brown firms and the brown firms generate a lot of emissions versus they invest in brown firms and nudging them to reduce emissions and results is a reduced negative externality. That change is what they are looking at. And because of that, investing in brown firms could be a good choice, makes them happier than investing in already green firms. So moral investors and impact investors, they both have ethical concerns that are valid, but their actions actually diverge. And the paper that I want to highlight is Omke and Ops that highlights this difference quite well. So moral investors care about portfolio carbon footprint, and therefore investing in brown firm reduces their utility. So the investing in already green firms is maximizing their utility. That's their optimal choice given their utility functional form. Whereas impact investors are comparing the counterfactual of brown firms staying outside of their portfolio versus brown firms now in their portfolio. And through their engagement, they're reducing the emissions. And that change is a positive impact. So caring about reduction in carbon footprint compared to a counterfactual scenario where the firm stays outside of their portfolio makes brown firms a potential part of their portfolio. And I will show later that indeed impact funds do hold more brown firms. So that contrast, even though they're both ethically concerned, can result in different outcomes for their portfolios. Now, even if the moral investors inherently are more concerned with their portfolio carbon footprint, in the aggregate, can their actions still generate impact? And in the literature, one channel that is potentially effective is the cost of capital channel. If all investors, all moral investors shun sin stocks, their cost of capital increase because they are starved of capital, and eventually their operations shrink or they are forced to change, and that means impact. But if there are other agnostic investors who are willing to supply competitive capital to sin stocks or brown stocks, then moral investors' withdrawal of their own capital would have a little impact. So coordination is key to this strategy. And literature is somewhat mixed, but overall, literature tends to find small or zero impact from this channel. For example, Burke and van Winsbergen finds that 1% change in a firm's cost of capital requires that moral investors hold 80% of investable wealth. So unless they are really large proportion of the total wealth, they're not going to be able to make a sizable impact. And Edmonds et al. Also find that engagement and conditional exclusion is more effective because you can nudge them to induce change than simple ex ante unconditional exclusion. So again, deontological investors are satisfied regardless of whether the firms change or not, while consequentialist investors want change to happen. So for consequentialist investors, this strategy is not so consistent with their goals. So that naturally leads to the question of, well, which goals do households want? There is some really growing collection of exciting papers that inform us, but I would say the jury is still out on this question and more research needs to be done. But just some highlights. Bauer et al. Studying Dutch pensioners find that post-social pension members are willing to accept lower expected return in exchange for impact. Heeb et al. 23 find that in experimental setting, investors' willingness to pay for impact is not linear. So either some inconsistency or maybe some confusion in the relationship between their willingness to pay and their action. Giglio et al. Looks at the survey results of US Vanguard investors, and they find that 25% of them invest in sustainable products for ethical reasons and 7% for financial value. So some prevalence of ethical reasons, although they don't differentiate between moral versus impact. Bonifon et al., another experimental study, aims to elicit the subject's willingness to pay for corporations who donate to charity. And the result is that investors who are altruistic, they're willing to pay regardless of whether donations depends on their stock purchase. And the author's interpretation is that this is more consistent with moral investors than impact investors. Again, I think that might be true with a perfect rationality or no confusion at all. But Heeb et al. Finds that retail investors are indeed tend to be over-optimistic about the impact of typical green investing products relative to experts. So that suggests there might be some naivete or confusion about how much impact products actually would generate. So overall, mixed evidence, moral exclusion, real-world impact, and financial materiality all drive retail investors' desire for sustainable investing. There's also evidence that retail investors are somewhat naive about the impact of all sustainable funds. I think this is something important. I'll come back to that. So now we have seen some evidence on households. What about the fund managers? Which goals do fund managers pursue? In the last 10 minutes or so, I want to touch on that question by talking about my other project where we study US mutual funds sustainable investing strategies. We are decoding this strategy using machine learning. So prior studies tended to use fund names, keywords in fund names, or third-party sustainable fund list, and Morningstar Globe ratings, and so forth. What is new here is that we analyze and extract what the funds say they do in their principal investment strategy in fund prospectuses, not relying on third-party lists. Funds compete for flows. Sustainable funds compete for flow with non-sustainable funds. So given that competitive landscape, what goals are popular and do they walk the talk? This was the motivation for our study. So referring back to the three goals of financial value, moral values, and impact, the core logic, materiality, alignment with values, and aim to cause a change, and example behavior. For example, avoiding high emission firms to reduce portfolio risk or mitigate or climate hedge, excluding sin stocks for ethical reasons, and investing in high emission firms to engage and reduce emissions. Those are just some samples of example behavior. To identify three types of sustainable funds, we first look at the principal strategy section of prospectuses and extract sentences that contain ESG keywords. We then manually code some of those sentences into these three goals, as well as some sentences not meeting criteria for any of the three. Using these manually coded sentences, we then train the model. The BERT model is what we use. And we also use some of that as a testing sample to make sure that the model is well trained. Once the model is trained, we then apply the model to all of US mutual funds for about 10 years. Using this methodology, we identify pretty rapid growth in sustainable funds, both in number and assets managed overall in that 10 years. In 23, we identify about 1,500 sustainable mutual funds operating in US, managing $1.7 trillion. What's very striking is that nearly 90%, 88% of these funds pursue financial goals, about 10% moral goals, and only 2% impact goals. So zooming in on that 2023 results, vast majority of the dollars managed by sustainable funds are managed by funds pursuing financial strategies. So their allocation is driven by financial propositions. They manage large funds and they charge fees about the same as traditional or benchmark funds. About 10% is managed by moral funds. They exclude certain sectors, brown and sin sectors. They are moderate in size and they actually charge the lowest fees of the three types. Now, only 2% are impact funds. They turn brown assets greener. They are small in size and consistent with their activist model, they charge higher fees. Do impact funds actually generate impact? That's a question I wanted to get back to. And here, using one standardized measure that people generally agree, emission intensity, we document that they in fact do generate positive impact. So impact funds with focus on environmental goals, their holdings are associated with reduced scope 1 and 2 emission intensity about 7 months after initial investment. So here is the 0, and starting in about 7 months, we see significant reduction in emission intensity. The effects persist, and this is in sharp contrast to financial or moral funds, where we find that there's no change in emissions intensity after their investment decisions. That's consistent with their goals because they are not aiming to generate that reduction in negative externality. This is a lower bound since not all environmental funds actually aim to reduce emissions. They can be targeting water, for example. So I think this is a evidence that the impact funds walk the talk. So overall, we find that the vast majority of asset under management is classified as sustainable, actually pursue financial moral goals. Impact funds are very small, but they behave distinctly. They hold browner funds in terms of lower ESG ratings. They use proxy voting very actively, especially for outcome-oriented proposals as opposed to disclosure-only proposals, which financial sustainable funds also support. And they improve ESG characteristics and emissions during their holding periods. But since financial and moral funds really dominate, we must conclude that financial sustainable investing capital available to retail investors is unlikely to generate significant positive impact, since that is not their goal. What about Europe? Some of you are from Europe. So we have an ongoing project where we focus on SFDR. EU introduced SFDR in adoption in 2021. So now funds designate themselves as Article 6, 8, or 9 funds. And in particular, 9 is referred to as dark green, often perceived to be more impact seeking. So we study using similar methodology to a US study, what the goals pursued by those Article 8 and 9 funds are. This is a very preliminary results. We find that compared to the US, there's a lot more moral goals being pursued, but and slightly more, but not much more impact. So yes, more ethical fund goals being pursued than in the US, which is in line with the previous studies. But between moral and impact, moral dominates. Okay, I think we have about 5 minutes left. So let me talk a little bit about some additional topics. We have seen some ESG backlash, particularly in North America recently. Texas and other red states have banned state pensions from hiring banks with pro-ESG policies. Their claim is that these funds are boycotting energy stocks, and an energy sector is important to some of those red states, such as Texas. What does the research have to say about the reality of these ESG funds in relation to these energy stocks? Our study finds that most of them are financially driven sustainable funds. And financial funds, we find overweight tech stocks, slightly underweight energy stocks, but for risk management reasons, because energy stocks have low ESG ratings, not due to activism. And some moral funds may say they exclude fossil fuel, but the percentage that are managed is much smaller than what the claims suggest. There is a related papers, Rajgopal et al., forthcoming in Management Science, find similar results. Funds banned by Texas actually have only a slight tilt away from energy and towards tech stocks, similar to what we find. And pension funds in red states actually hold similar tech and energy stock exposure as blue state pensions. So they don't look that different in what they actually invest in. If impact funds are what is considered woke, only 2% of ESG funds are woke. So they have very little sway even before the Texas ban took hold. So maybe it's possible that both pro-ESG and anti-ESG political groups may be confused about the prevalence of impact funds among sustainable investing. And the reality is that most of them are not impact funds. What about performance? I know practitioners particularly really want to focus on that. Of course, that's an important question since they are competing for flows. Does sustainable fund performance vary by their goals? And so far, we have not found that much difference in risk-adjusted performance by their goal. But flow sensitivity does vary. Flow performance sensitivity of moral funds are less sensitive, so they get to enjoy this nice benefit that whereas the impact and financial funds are not statistically different in their performance flow sensitivity relative to benchmarks. So this is consistent with prior literature that find that SRI funds, that those are typically moral exclusion oriented funds, they have less outflows after poor performance. Moral funds are also cheaper to operate. They're passive and just screening ex ante than impact funds. They're active and costly to engage with the firms and do proxy voting and so forth. So it's suggestive evidence that fund managers that are competing for flows from pro-social investors may find it more profitable to run moral funds or attempting to run moral funds than impact funds. There are some policy implications that policymakers might consider given all the outcomes of the research. One is what Europe is doing is to differentiate financial, moral, and impact in fund designation so that different fund types are competing in segmented markets. That way, moral funds compete with other moral funds, financial sustainable funds compete with other sustainable financial funds, so forth. SFDR in Europe seems to be a good start, and further refinement can improve fund managers' incentives. Another area where I think both the research is very preliminary because we don't have standardization is the quality of impact measures. So regulating and certifying quality of impact can increase trust and alleviate impact washing concern. So to wrap up, I hope the lecture has communicated that financial and moral and impact goals are all distinct, and only impact funds aim to generate positive externality. And though very small, they do generate positive outcomes. Moral funds might satisfy investors' ethical goal, but not likely to generate impact. Some investors are willing to pay for impact, but the retail investors might confuse all sustainable funds as impact funds, and that's a problem for impact funds that are true impact funds. And fund managers are incentivized to compete for flows. So free riding problems that we still have that I alluded to in the beginning, and difficulty in verifying the impact. This might limit impact funds' scale vis-a-vis financial and moral funds. These are the problems that we identified. So although maybe this result may be somewhat disappointing for those who want to see impact play a bigger role, But my hope is that this type of research identifies where the issues are and pushes for changes that result in better matching between investors who want a particular goal, say impact, and funds that pursue that goal. And that better matching should be overall welfare improving for both the households and the ultimate sources of capital, as well as the companies that receive the capital from the funds. So this concludes the end of my lecture, and I'm now looking forward to hearing Asha's and everybody's thoughts and questions. Thank you. Thank you very much for your attention.
Well, thank you so much, Professor Ayako, for your very insightful lecture. And actually, I do share with you that the connecting goals with outcome is very important because I think when we're doing sustainable investing, the first question we should ask ourselves is why we are doing it, right? So the motivation will matter a lot for how we are doing sustainable investing and the subsequent outcomes. Yeah. So now let's move to our Q&A discussion. So our moderator today is Asha Mehta. She's the founder and also the Chief Investment Officer of Global Delta Capital. So Asha focuses on emerging and frontier markets and sustainable investing. She was named one of the top 10 women in asset management by Money Management Executive and also profiled as a brilliant quant by Forbes magazine. Similar as Ayako, she has also published a book by Wiley on power of capital and a venture capitalist journey to a sustainable future. So please check it out. Right, so today we are very lucky to have Asha to have this conversation with Ayako. We are very looking forward to learning how you actually reflect on the lecture based on your field experience, your questions, and your thoughts with Ayako. So Asha, now I'll pass the floor to you.
Thank you so much. I'm delighted to be here. I learned a lot from Dr. Yasuda's talk, and I'm delighted to moderate some question and answer session. We've received many questions from the chat, and we'll be integrating that in the discussion that we have forthcoming with Dr. Yasuda. First, I wanted to begin by sincerely thanking Dr. Yasuda for this very, very informative discussion. I think the framing that you've brought to this discussion is both novel and pragmatic. This framing around impact investing versus moral investing versus value-based investing. It brings much needed clarity to a space that has faced a backlash, as some of you have noted in the commentary, especially here in the US, because this term around ESG has been heterogeneously defined, as Dr. Yasuda says. The goals of investors themselves have been muddied. The measures of conviction and performance relative to those goals have been muddied as well. And that has led to some of this backlash. So I think what has been presented here is actually quite orthogonal to these traditional notions of environmental, social, and governance in a way that's both practical and helpful. I appreciate as well your timely comments covering this backlash here in the US, the helpful literature review. And I was particularly intrigued by the research on investors' willingness to pay for various strategies. I thought your findings were quite robust, given that the impact investing space is inherently novel. It's inherently new for investors to be considering impact investments at scale. I consider this space a space with a dearth of data, so I was impressed by the robustness of your conclusions, and again, look forward to a discussion. Before I open it up for Q&A, I just wanted to provide some context around the types of investment strategies you've mentioned here in a historical context. When I think of the moral type investing that you spoke about, it reminds me of traditional notions of SRI, socially responsible investing, which is exclusions-based investing. And to your comments, has had mixed evidence in terms of how impactful it can be. But much of the movement around SRI investing actually came from the apartheid movement led by the US and Europe, where SRI funds put pressure on companies not to do business with South African companies. And that campaign was viewed to be a very successful one in SRI history. Billions of dollars of capital was withheld from South Africa until change occurred. So that was kind of the birth of SRI investing at scale. And, from a pragmatic investor standpoint, I'll say the lessons learned have been, especially in this era of big data, that implementing these types of strategies can be quite straightforward. I come from a systematic background and in a context where you're covering a breadth of securities and using an optimizer-based approach to build a portfolio. To exclude a set of securities can be quite trivial from an investment perspective. So that's what I think about as Sustainability 101, these traditional notions around SRI. And over the last, call it 10 to 15 years or so, the movement has moved into what we call ESG integration, or the integration of sustainability concepts into an investment framework. This view that, it doesn't have to be entirely an exclusion-based approach, which is almost inherently concessionary. Again, I get the data is mixed, but from a first principles perspective, if you're excluding a set of securities from your universe, that can result in an approach that can be suboptimal or concessionary in nature. So the last 10 to 15 years has brought the birth of ESG integrated approaches. Investors have integrated sustainability both from a lens of alpha generation. If I invest in companies that are well governed and have good business practices in place from a social or environmental perspective, perhaps those securities will outperform. Investors have also approached that integrated approach from a risk mitigation perspective. But whatever the theory is behind sustainable investing with an integrated approach, inherently the objective is about how can investors generate alpha or generate better fund performance by investing in, quote, responsible companies. And I say this to contextualize sort of this birth of impact investing at scale, where the notion is not just about how can the portfolio benefit from investing in these companies, but actually how can the investee companies benefit from the investments themselves. And this is what motivated my book, Power of Capital. As Dr. Yasuda said, it is feasible for investors to approach investments with this notion around a dual purpose of investing, that by investing through an intentional lens, we not only can generate returns for our investors, but we can also have directional impact in the communities in which we're investing. So I set up that historical context again to reflect and to motivate some of the Q&A. I see this movement as a journey, and my own sort of view as we approach this moderated session is around how can we develop strategies to scale impact, because ultimately we do live in this era of big data. The tools available to us are fundamentally different from what we had 30 years ago or 60 years ago. And as Dr. Yasuda elegantly laid out, we live in a more integrated context today where, the asset management movement can appreciate its role in the broader financial ecosystem. So with that, I'll invite Dr. Yasuda back and kick off with my first question for you. I'm wondering if you can speak to, again, those three goals, value, morals, and impact, and speak about which of these are resonating most with end investors, whether those are retail, high net worth, or institutional investors.
Sure. That is really an important question, because ultimately fund managers should be catering to the desires of the source of the capital, right? And I think there is a growing literature, and I read those papers with great interest. And I think the honest answer is the academics are yet to have the final word on this question. And I listed several papers in my talk. I think that retail investors do tend to have a ethical interest. Ethical here I just mean values. So it contains both moral and impact. And I think the tricky thing is knowing exactly what people mean by I want to be ethical may be difficult to elicit exactly whether you're running an experiment or you're asking subjects some hypothetical questions. There's always the risk that the experiments, their answers in the experiment may not be exactly matching to how they actually invest in the real world. And similarly, we rely on surveys, and then we are talking about a pretty select set of respondents to those surveys. So they might be a segment of the broader population. So pensioners might be a different segment of respondents than Vanguard investors. So I think that we have only speculations at this point. I'll be just really honest. I don't think we truly know. But what we can say as economists instead is that fund managers are known to have their own career concerns and their own interests. So how they compete with other types of funds are likely to affect how they behave. And therefore, that agency issues between fund managers as agents and households as principals provide, I think it generates a possibility that there may be a mismatch between what the households actually want and what the fund managers provide, because then fund managers are also people with career concerns and things like how can they increase the size of the funds and what kind of fees can you charge and still provide a competitive returns to the households that tend to maybe here I am being a bit speculative, but that might induce the fund managers who want to offer something with non-pecuniary benefits, not purely financial sustainable funds, to prefer moral goals as opposed to impact goals, irrespective of whether that's what the households actually want. And I cannot say if the households want impact more than moral because we simply lack rigorous evidence, rigorous comprehensive evidence. But let's say at this point we are agnostic, it's 50-50. There are a lot more moral funds being offered than impact funds being offered. And I can think of economic reasons why that is. It's cheaper to offer, like you said, Asha, it's pretty straightforward to operate. So it's a low cost investment. And if they enjoy lower flow performance sensitivity, why not offer that? It is an easier life for fund managers to make a good living than doing impact fund. Doing an impact fund, I think, is hard, and they don't necessarily get rewarded for it through lower performance flow sensitivity. So I think you can see why impact fund remains the smallest segment. Whether or not that means nobody wants impact funds, or if there is some latent demand, but we cannot really meet them because the labeling doesn't really differentiate them necessarily, or even differentiating might give them a bad reputation because they tend to be associated with lower return. These are all, I think, reasons to at least suspect that there might be a mismatch. And that's a problem, free riding problem that we have not been able to solve. I hope that's somewhat answers your question.
Thank you. Yes, it covers a lot of ground. And just from my own view, being on the ground as a fund manager, experiencing multiple
Yes.
objectives, both myself as well as from the investor community, what you're speaking about certainly resonates. And I couldn't agree
And I
more
do
with
want to
you.
hear you. I want to hear this your thoughts as somebody on the ground. What goals do you
Right.
most frequently hear being expressed by your potential clients?
Yeah, no, I ultimately I observe that the community is moving toward impact. And I'm seeing that, to your point, it's dispersed across the retail and the institutional communities. Perhaps the individual measures will differ, but I really believe it'll differ by investor more so than investor type, retail versus institutional. There's just tremendous heterogeneity. And I understand, we're communicating in a global context today, and I would extend these comments actually to a global context where needs within retail investors will vary, needs across retail versus institutional will vary, and institutional in the US, and you covered this in your literature, will vary from needs in Europe or in Asia. So it remains a very heterogeneous community. And in terms of, the investor preferences with respect to more of a morals approach or an impact related approach, I think you've well characterized, the rationale for the growth and the moral strategy. We have the tools to do this today. It's well defined. It's, one can readily report against those applications. And I appreciate you've just laid out, helpfully, the challenges in taking an impact-oriented approach. Again, it's a more nascent approach. It's harder to define what is impact. It's harder to, compare one impact manager to another. We have had in the Q&A a series of questions around impact measurement. You and I spoke about this a bit ahead of our session. So I wanted to kick off a question on that space. We know that impact, again, is inherently nascent. The objectives in the impact space can be quite varied. And there is no, universal measurement tool for impact today. I wonder, what does your research show around methods for impact measurement? And what is your view as we develop these cohesive methods for measurement on how the birth of AI, you mentioned machine learning tools, we live in the era of data science. How do you see this impact measurement space evolving over the next several years?
I can talk about what I hope would happen, which is that this is an interesting evolution in rating agencies. So ESG ratings, as many of you know, there are multiple entities that generate ESG ratings. There's own sort of literature on how those ESG ratings are measured differently for the same firm and etc. So I can refer you to some papers on that. But the point I want to make is that I think that earlier times in sustainable investing, there are more ESG ratings that included measurements of impact. And over time, what the objective of ESG ratings measure became more and more materiality driven. So today, if you think about MSCI ratings, their methodology is pretty clearly materiality driven and cater to financially driven sustainable investors. And that serves a real purpose. But I think given that there are three distinct goals, and in particular, impact investors care about outcomes, there could be a alternative to materiality-driven ESG ratings that are done by professionals with standardization, and you can use AI all you want to come up with measures that impact investors can look to and use as a reliable measures. I think the industry has moved towards directions of more and more purely materiality driven measurements. And maybe given that 88% of AUM is managed by financial funds, that's just simply supply and demand. But for impact investing to scale, maybe this is where some sort of a nonprofit subsidy is very much welcome to establish a collective organization that can supply this type of measures. There is GIN, and GIN has done a wonderful work in creating Iris, the definitions of different standards, I think that in public space, there is a need for a more simplified measures. And so I think that that's something that could really improve this trust that we have in financial measures. That's why markets are very, very well functioning, is that we generally trust that financial metrics are measured consistently. I think accountants can play a big role here, and I know there are accounting colleagues in business schools that are working to come up with basically equivalent of financial statements that are very standardized, developed over time, but doing the same for sustainability measures. Again, the efforts have been mostly on the materiality issues because that's definitely where accountants care a lot about. But there could be a parallel development of impact-oriented measures that accountants can help us standardize. So I'm all for standardization, all for use of new methodologies. Just to say something separate about use of AI, you mentioned concessionary return on moral funds and others. There are other research showing that using AI, if your goal is to provide competitive return, you could do that with less concessions than before. So AI is being implemented to limit that the concessionality for moral investing. I think yeah, let me stop here. I know that we have limited time, so let's get to some more questions.
Of course, of course. And I'll just echo some of the comments you made and give a brief twist before I shift to the next category of questions. But I agree with you, this AI era or this data science era, the ability to look across a broad universe and again, exclude a relatively small set of securities makes for a framework where an exclusionary approach, to your point, can have a much more limited impact. And I'll just share some research that we've run recently shows that, in fact, we expect that detraction to be very small. What we've seen over the last 10 years or so, those exclusions have actually been positive. And so there is, of course, a lens one can use to suggest that this moral-based approach will be additive in the future. But you've got to take it sort of the philosophical view that a global carbon tax, for example, will merit taking a fossil fuel strategy in hand, that there's an inherent investment rationale there. You've talked about standardization of impact frameworks. I couldn't align more in the value on standardization, but I will highlight, as you did in our prep session as well, there are risks of standardization as well, that impact approaches in many contexts are highly specified. If we're trying to measure the impact of a given strategy, one fund manager's theory of change will differ from another's. Yeah. So there's value in taking a more specified approach. And the next generation, right? This is what, I shouldn't say the next generation, our generation is tasked with. How do we find that balance between standardization and more dedicated approaches? You've mentioned, you wanted to make a comment on that?
Just a quick, I really appreciate you brought that back because I think inherently, especially in a private market space, investing horizon is even longer. So once you focus on standardization, there is a risk of focusing more on short-term metrics as opposed to a long-term metrics. And some impact investing talks about generational metrics that you can only measure it in the next generation, or system impact. So how do you measure a system impact? And I think that is not to be de-emphasized in any way. So if anything, for impact investing to get traction, we want to be able to incorporate that system impact into the benefit. So that's really the dilemma. I have a sort of a dilemma between, yes, there's a great benefit to standardization, but then then we don't want to be subject to all the ills of the short-termism.
Let's move to I want to be mindful of time, and I know we could continue this discussion for a long time. There are many questions coming through the Q&A that we're just scratching the surface of. But we would be remiss if we didn't have a brief discussion, at least on policy, especially as we turn to more systems-oriented approaches. You did mention some policy considerations in your closing remarks. And I wonder if you could speak a bit more about what you see as likely or valuable potential policy developments, whether that's from a US or a more global context.
I think that number one message that I have is that the word sustainability term contains under this umbrella goals that are quite distinct. And right now, investors may be simply confused about what goals that a given fund that they are investing in is actually pursuing. And so I would advocate for more segmented competition where given type of funds can compete with other funds of the same type, and then let the best ones win. And in order to allow that to happen, makers can play a very important role by allowing that fund designations to be reliable and trustworthy. So I like the SFDR initiatives, although my research will likely have some suggestions for refinement of that initiative because they still seem to prioritize moral as opposed to impact. But any type of trusted designations where funds can self-designate themselves, and of course they need to be evaluated. That kind of labeling would be very beneficial. So that would be the number one policy suggestion that comes out of the academic research.
Thank you. As a boutique manager, I often think about the benefits of being a first mover versus a fast follower. And I would say in the context of policy developments, there's likely benefits in being a fast follower to the SFDR approach. I think your research has really highlighted the value and the opportunities that can arise from the SFDR framework, but it's been a framework that's in place for, been in evolution for many years and caused considerable anxiety across the investor community. So many thanks to our European colleagues who were first movers on this and went through,
That's right,
are going through many of the challenges.
Yes.
I want to move us to closing remarks, and I'll just share my own view, and Dr. Yasuda, let you have the last word here. But my own view is, recognizing that we're speaking to a global community through a university-hosted framework, and we have many people who are earlier or midway through their careers on this call. And I wanted to come back to Dr. Yasuda's notion around materiality. I remember vividly when this notion was coined. It's very, very recent history, and it has become pervasive across this industry. It was a very helpful framework that, in fact, moved the industry toward thinking about ES&G. Prior to this ES&G framing, there was decades of research on governance. They put G at the end of ENS to give the ENS some heft. And I bring all these anecdotes up to highlight that history can be made very, very fast. And I appreciate all of the attendees on this call. I see this trend toward impact as a trend toward the next generation of finance. And I thank you all for being here. And I want to make it, profoundly clear that you can have a role in shaping how the impact industry evolves. Dr. Yasuda, over to you for the last word.
Thank you, Asha. Thank you for this conversation. Thank you, everybody, for staying till the end. There are 4 things that I want to say to wrap up. Impact investing is explicitly dual objective and activist. Investors in impact funds, at least in the VC space, they are willing to pay for impact. We show that. Most sustainable mutual funds available to households today are not impact funds, and the ESG label that's too broad does not make this very clear. So to researchers in the room, empirical research that quantifies the role of sustainable finance in solving E and S problems and challenges, I think we need to note the fact that most capital managed by quote unquote sustainable mutual funds is not mobilized to generate externality. And that changes interpretations of many of the objects that we are researching. I hope that is something that we can use in pushing our literature forward. Thank you so much.
Yes, thank you so much, Professor Ayako, and also Asha, for this very thought-provoking conversation. So, just let me quickly conclude our lecture today. So, this marks actually not only the end of this lecture, but also the inaugural year of our NBS-PRI-ECGI public lecture series. So we are very much grateful for the contribution of all our academic and practitioner speakers, as well as our very engaging audience all along the way. And this wouldn't be possible without you. And I would also like to thank our dedicated organizing committee from NBS-PRI and ECGI for your hard work in making this series a very huge success. So, well, in this vein, I'm very happy to share that we are going to continue this conversation next year with 8 more lectures. And the first lecture will be online on Tuesday, January the 13th, delivered by Professor Marcin Kasperczak from Imperial College London, UK, and moderated by Sarah Rosner from Aliens Bursing. So please mark the calendar and scan the QR code on the screen to register. We all look forward to seeing you again next year, and we wish everyone a very joyful December and happy holiday. So thank you so much, and we'll see you next year.